Elliott was not a Wall Street titan or a boy genius speculator. He was a meticulous and successful accountant and business consultant, a man who had spent his life bringing order to complex systems, from reorganizing railway finances in Central America to managing public utilities. His world was one of numbers, logic, and structure. In 1934, at the age of 66, an intestinal ailment forced him into retirement. Faced with an idle mind and a desire for a new, great problem to solve, he turned his full analytical powers to the stock market. He embarked on a monumental and almost monastic task. In an era before computers, he began a deep, systematic study of 75 years of historical charts of the Dow Jones Industrial Average and its predecessors, spanning from 1857 to his present day. He analyzed yearly, monthly, weekly, daily, and even half-hourly charts, searching not for short-term trading signals, but for a grand unifying principle. And after several years of relentless, painstaking work, he had a moment of profound discovery. He found it. He believed he had uncovered the secret rhythm of the market, a set of recurring patterns that governed the ebb and flow of all human endeavor. He called it the Wave Principle. What he had discovered, he claimed, was not merely a new tool for stock market forecasting. He believed he had found the visual manifestation of the natural laws of human mass psychology. The stock market, with its vast and detailed data set, was simply the most perfect laboratory in which to observe this phenomenon. The patterns he identified were, in his view, a roadmap to the very structure of how human populations move from pessimism to optimism and back again. This video is a masterclass on his incredible discovery. We will dissect his entire theory, from its basic building blocks to its most complex applications, and we will seek to answer the profound question at the heart of his work. How did this man, in the twilight of his life, using only paper, pencil, and a remarkable analytical mind, discover what he believed was the universal roadmap to mass psychology? Before we continue, please subscribe and leave a quick comment. Even one word. This small action helps the algorithm show this video to more people and tells me these deep dives are worth making. To truly appreciate the depth of the Elliott Wave Principle, we must first understand the mind of the man who discovered it. Ralph Nelson. Elliott was not a speculator by nature, he was a scientist. His entire professional life was dedicated to the analysis of complex systems and the imposition of order upon them. As a consultant, his job was to enter a struggling business, diagnose its structural flaws, and redesign its processes for maximum efficiency. His mind was trained to look at a chaotic mess of data and find the underlying pattern, the root cause, the unifying logic. When illness forced him into retirement in his mid-60s, he did not see it as an end, but as an opportunity to apply his well-honed analytical skills to the greatest and most complex system of all, the stock market. He approached the market not as a gambler seeking a lucky streak, but as a naturalist approaching a new ecosystem, convinced that there were discoverable laws governing its behavior. For 5 years, he dedicated himself to a rigorous, almost obsessive study of market history. He hand-drew charts, made countless annotations, and tested dozens of hypotheses, most of which failed. But in 1938, at the age of 67, he experienced his eureka moment. He had found a consistent, repeating structural pattern that seemed to underlie all the market's movements. Excited by his discovery, he began a correspondence with Charles J. Collins, a stock market analyst and writer. After Collins became convinced of the validity of Elliott's work, he arranged for Elliott to publish a series of articles in Financial World magazine, publicly introducing his theory. In those articles, Elliott used his newfound principle to make a bold and astonishingly accurate prediction that the great bear market that began in 1989-1937 was ending, and a new major bull market was about to begin. When the market bottomed exactly as he had forecast and began a powerful new advance, the financial world began to take notice. So what was the monumental discovery that allowed him to make such a prediction? It was the observation of a simple, fundamental rhythm. Elliott discovered that the market moves in a repetitive pattern of 5 waves in the direction of the main, larger trend, followed by 3 waves against it. This 5-3 pattern, he claimed, is the single, immutable, foundational building block of all market movement, from the smallest intraday fluctuation to the grandest multi-century advance. The 5-wave structure he termed an impulse, as it is the primary engine that impels the trend forward. The 3-wave structure he termed a correction, as it represents the necessary pause or counter-trend movement that corrects the preceding impulse. Let us now conduct a deep anatomical study of the engine of the trend, the impulse wave. This 5-wave structure, which Elliott labeled simply as Wave 1, Wave 2, Wave 3, Wave 4, and Wave 5, has its own specific set of rules and characteristics. Understanding these is the absolute key to applying his principle. Elliott identified 3 of these rules as unbreakable. If you observe a market movement that violates any of these 3 cardinal rules, your analysis is incorrect. The pattern you are looking at is not an impulse wave. Cardinal rule number 1. Wave 2 can never retrace more than 100% of Wave 1. Wave 1 is the initial push in the direction of the new trend. It is often tentative, rising from the ashes of the previous bear market. It is followed by Wave 2, a corrective pullback. This rule states that the low of Wave 2 can never go below the starting point of Wave 1. The logic is simple. If the pullback completely erases the initial advance, then there was no initial advance to begin with. It was a false start, and the prior trend is likely still in force. This rule ensures that a true impulse has, at its very foundation, made some form of net progress. Cardinal rule number 2. Wave 3 can never be the shortest of the 3 impulse waves, waves 1, 3, and 5. This is perhaps the most important rule. Wave 3 is the heart of the trend, the center, and the most powerful part of the entire sequence. It is the point where the new trend is broadly recognized, participation increases, and the price moves with the greatest force and confidence. This rule ensures that the main thrust of the market's advance is, in fact, a powerful and extended move. While Wave 3 is often the longest of the 3 impulse waves, it is not required to be. It is only required to not be the shortest. This rule is critical for correctly identifying the main engine of a trend. Cardinal rule number 3. Wave 4 can never enter the price territory of Wave 1. This means that the low of the corrective Wave 4 cannot overlap with the high of the impulse Wave 1. This rule is what gives an impulse wave its clean stair-step appearance. It ensures a clear separation between the market's initial push and its final consolidation phase before the end of the trend. The territory of Wave 1, once conquered, should not be relinquished during the Wave 4 correction. A violation of this rule often indicates that the market is not in a powerful trending impulse, but is instead forming a more complex, sideways corrective pattern. These 3 unbreakable rules form the rigid skeleton of the impulse wave, the scientific foundation of the entire principle. But Elliott's next discovery was perhaps his most profound and intellectually beautiful. He realized that the 5-3 pattern was fractal in nature. A fractal is a pattern that is self-similar at every scale. Think of the branch of a tree. Its shape, with a main stem and smaller branches coming off it, is a miniature version of the entire tree with its trunk and larger branches. Think of a coastline on a map. Its jagged, irregular pattern looks the same whether you are viewing it from space, from an airplane, or from a few feet away. This is the principle of self-similarity. Elliott discovered that the stock market is a perfect, naturally occurring fractal. The 5-3 pattern is not just a single event, it is a repeating structure that exists on every time scale, on every degree of the trend. For example, the great bull market that lasts for decades, which Elliott might call a supercycle, will be composed of 5 massive cycle waves. But if you zoom in on the first of those cycle waves, you will find that it too is composed of 5 smaller primary waves. And if you zoom in on primary wave 1, you will find that it is made of 5 intermediate waves. This continues in theory all the way down to the smallest fluctuations on a 1-minute chart. The universe is contained in a grain of sand. The pattern of mass psychology that takes a lifetime to unfold is the exact same pattern that unfolds in a single trading session. This was a revolutionary insight. It meant that the market was not just a series of patterns, but a single repeating pattern, an endlessly unfolding and beautiful structure of organized complexity. It was the discovery of a universal law of market motion. The discovery of the 5-to-3 pattern and its fractal nature was a monumental achievement, a revelation that brought a sense of underlying order to the market's apparent chaos. But for this principle to evolve from a fascinating observation into a powerful analytical tool, it required 2 more layers of depth. The first was the discovery of its mathematical DNA, the hidden numerical code that governs the proportions of the waves. The second was the understanding of the unique psychological personality of each wave, the human story of hope, greed, and fear that each phase of the pattern represents. It is the synthesis of these 2 elements, the mathematical and the psychological, that elevates the Elliott Wave Principle to a true masterclass in market analysis. As Ralph Nelson Elliott meticulously measured the relationships between the waves on his historical charts, he found that they were not random. They were consistently and beautifully related to each other by a set of ratios derived from a mathematical sequence discovered in the 13th century by the Italian mathematician Leonardo of Pisa, better known as Fibonacci. The Fibonacci sequence starts with 0 and 1, and each subsequent number is simply the sum of the preceding 2. 0, 1, 1, 2, 3, 5, 8, 13, 21, 34, and so on into infinity. The true magic of this sequence is in the relationship between the numbers. As you move up the sequence, the ratio of any number to its preceding number approaches a remarkable and irrational constant, approximately 1.618, known as the golden ratio, or phi. The ratio of any number to the next higher number approaches its inverse, approximately 0.618. These ratios, along with others derived from the sequence like 0.382 and 0.500, appear with startling frequency in the natural world, governing the spiral of a seashell, the arrangement of petals on a flower, and the proportions of the human body. Elliott discovered that this same universal natural code of growth and decay was the mathematical foundation of the stock market. He found that these ratios appeared in 2 primary ways, in retracements and in extensions. Fibonacci retracements are most common in the corrective waves. After an impulse wave pushes the market forward, the subsequent corrective wave will often retrace or give back a predictable Fibonacci percentage of that advance. Wave 2, the first correction in a new trend, is typically a deep and severe test of the market's conviction. As such, it often retraces a significant portion of Wave 1, frequently pulling back to the 61.8% or 50% level. This deep retracement serves a psychological purpose. It creates maximum doubt about the validity of the new trend, shaking out all but the most committed early participants. Wave 4, the second correction, occurs when the trend is already well established. The psychology is one of profit-taking and consolidation, not deep-seated doubt. Therefore, Wave 4 is typically a shallower retracement of the powerful Wave 3, often finding support at the 38.2% level. Elliott also observed a guideline of alternation. If Wave 2 is a sharp, steep, and simple correction, Wave 4 will often be a shallow, sideways, and complex one, and vice versa. Fibonacci extensions, on the other hand, are used to project the length of the impulse waves. Wave 3, the heart of the trend, is almost always the longest and most powerful impulse wave. Its most common relationship is that it will be 1.618 times the length of Wave 1. This golden ratio extension is the signature of a healthy, powerful trend in its prime. Wave 5, the final impulse, has a more varied set of common relationships. It is often approximately equal in length to Wave 1. Another common relationship is that Wave 5 will travel a distance equal to 0.618 times the length of Wave 3. This mathematical framework provides an objective way to set price targets and identify areas of probable support and resistance, transforming the wave principle from a simple pattern into a tool for probabilistic forecasting. But to truly master the principle, one must understand that each wave is more than just a mathematical proportion. It is a chapter in a psychological drama. Elliott taught that each of the 8 waves in a full cycle has its own distinct and recognizable personality. Wave 1, the hesitant start. This wave represents the first tentative push off a major bottom. The psychology is one of extreme pessimism. The news from the previous bear market is still universally bad. Most market participants are convinced that this is just another sucker's rally, a minor bounce in a continuing downtrend. The advance is often choppy, difficult, and unconvincing. It is only in hindsight that it is clearly identified as the start of a new bull market. Wave 2, the test of conviction. This wave is a deep and frightening retracement of Wave 1, often giving back 61.8% of the initial advance. It is the market's great test. The pullback is so severe that it convinces the vast majority of participants that the bear market is, in fact, still in force. The mood turns bearish once again. However, a key tell is that volume during Wave 2 is typically much lower than it was during the final decline of the prior bear market, indicating that the selling pressure is not as intense as it appears. This wave is designed to shake out the early, weak-handed bulls and set the stage for the most powerful part of the trend. Wave 3, the heart of the trend. This is the moment of confirmation and power. Wave 3 blasts through the previous high of Wave 1 and begins to accelerate. It is the longest and most powerful of the impulse waves. The public finally begins to recognize that a new bull market is underway. The news turns from bad to good. The trend is now broad-based, with many stocks participating in the advance. Volume is heavy and price gaps are common. This is the wave where the trend is undeniable, and it is where the majority of the gains are made. Wave 4, the frustrating pause. After the explosive power of Wave 3, the market needs to rest. Wave 4 is a period of profit-taking and consolidation. Its personality is frustrating and deceptive. It is often a complex, sideways, and time-consuming correction that can last for a long period. It erodes the confidence of impatient bulls who want the trend to continue, and it gives false hope to bears who see the sideways movement as a major topping pattern. However, according to the rules, it should not overlap with the top of Wave 1. It is a necessary and healthy pause before the final act. Wave 5, the final push. This is the last impulse wave of the trend. The move is often driven not by sound fundamentals, but by pure public euphoria and herd mentality. The news is universally positive. Everyone is bullish. It is in this wave that taxi drivers are giving stock tips, and magazine covers are proclaiming a new paradigm of permanent prosperity. However, the advance is often less dynamic than Wave 3. A critical warning sign that often appears in Wave 5 is a technical divergence, where the price pushes to a new high, but momentum indicators like the RSI or MACD fail to confirm, making a lower high. This shows that the energy behind the trend is waning, even as the price makes its final optimistic push. Wave A, the first crack. This is the first leg down of the new, larger bear market or correction. The psychology is one of denial. Most participants view this sharp decline as a normal correction in the ongoing bull market, a buying opportunity. They believe it is just another Wave 4. However, Wave A is often more severe and widespread than the previous corrections, serving as the first true warning that the primary trend has changed. Wave B, the sucker's rally. This is perhaps the most deceptive and dangerous wave in the entire sequence. It is a rally within a new bear market that convinces many that the bull market is resuming. It retraces a portion of the losses from Wave A, bringing back a false sense of optimism and luring in the last of the unsuspecting bulls. It is the ultimate bull trap. A key tell is that volume during the wave B rally is typically weak and unconvincing compared to the impulse waves of the prior bull market. Wave C, the waterfall decline. This is the final devastating leg of the correction. It is in this wave that the public finally and painfully realizes that they are, in fact, in a bear market. The mood shifts from denial to panic. The selling becomes relentless and broad-based. Wave C is often as long as, or even longer than, Wave A, and it is where the most damage is done to the portfolios of those who refuse to accept that the primary trend had changed. It is the wave that erases the last vestiges of hope and sets the stage for the entire 8-wave cycle to begin anew from a point of maximum pessimism. By combining the objective mathematical framework of Fibonacci with this deep, nuanced understanding of the market's psychological personality, the Elliott Wave Principle provides a complete and holistic map for navigating the complex journey of the market. Having established the foundational 5-to-3 pattern, the unbreakable rules of impulse waves, their fractal nature, and their mathematical relationship to the Fibonacci sequence, we now arrive at the most challenging and nuanced aspect of the Elliott Wave Principle. This is the part of the masterclass that separates the novice from the serious student. While impulse waves are the relatively straightforward narrative of a trend, corrective waves are the complex, often frustrating, and highly varied arguments against it. Ralph Nelson Elliott discovered that while the market moves forward with a singular purpose, it corrects itself in a multitude of different ways. Understanding these corrective patterns is the key to navigating the most difficult and deceptive market environments. Elliott categorized the near-infinite variety of corrections into 3 main families, each with its own internal structure and psychological personality. The first and most common family is the Zig-Zag. This is a sharp, swift correction that moves aggressively against the primary trend. Its internal structure is a 5-3-5 pattern. This means its first leg, Wave A, is itself a 5-wave impulse. It is followed by a 3-wave corrective rally, Wave B, which then gives way to the final and often most powerful leg, Wave C, which is also a 5-wave impulse. A zigzag creates a deep and rapid retracement of the prior trend, signifying a strong but temporary victory for the counter-trend forces. Its appearance is sharp, clear, and decisively against the prevailing trend. The second family is the flat correction. Unlike the sharp zigzag, a flat is a sideways, frustrating pattern that signifies a period of consolidation where the forces of the trend and counter-trend are in a powerful but temporary state of equilibrium. Its internal structure is 3-3-5. This means Wave A is a 3-wave move, not 5. It is followed by a Wave B rally, also a 3-wave move, which is notable for its strength. It often retraces nearly all of Wave A, creating a sense of confusion and false hope that the primary trend is resuming. This is then followed by a final 5-wave move, Wave C, that concludes the pattern. Flats have several variations, from regular flats, where Wave C ends near the low of Wave A, to expanded flats, a highly deceptive pattern where Wave B actually makes a new high above the start of Wave A, and Wave C then drops to a new low below the end of Wave A, trapping both bulls and bears. Flats are the embodiment of market frustration and sideways, range-bound action. The third family is the triangle. Triangles are a special type of sideways correction that represents a coiling of energy, a decrease in volatility and conviction before a final move. Their internal structure is a 5-legged pattern, labeled ABCDE, where each leg is itself a 3-wave corrective move, creating a 3-3-3-3-3 structure. Triangles almost always appear in the position just prior to the final actionary wave in a sequence. This means they most commonly form as a Wave 4, just before the final Wave 5 impulse, or as a Wave B in a larger ABC correction. They are the market taking a final deep breath before its last push. This intricate world of corrective patterns leads us to the most honest and critical part of this analysis: the immense difficulty of applying the Elliott Wave Principle in real time. The primary criticism leveled against the principle is that it is subjective. In the chaotic heat of a live market, identifying the correct wave count can be extraordinarily difficult. What one experienced analyst sees as the end of a wave 3, another might see as merely a subwave within a still extending wave 3. This is the problem of alternate counts. A true professional Elliott Wave analyst does not operate with a single rigid forecast. Instead, they maintain a primary, most likely wave count, and at least one or two credible alternate scenarios. This is the correct way to understand and apply the principle. The Elliott Wave Principle is not a crystal ball. It is not a deterministic machine for predicting the exact future. It is a probabilistic roadmap. It is like a powerful GPS for the market. It shows you the main highway, which is your primary count, but it also clearly displays the potential detours and side roads, which are your alternate counts. Its true genius lies in its ability to identify critical, objective price levels, specific highs and lows, that will either confirm your primary count or, if broken, invalidate it and elevate an alternate count to the primary scenario. It is a dynamic, logical framework for thinking in probabilities and, most importantly, for managing risk around key inflection points. To see this theory in action, let us briefly analyze one of the greatest bull markets in history, the run from the 1982 low to the 2000 high. From an Elliott Wave perspective, this entire 18-year period can be seen as a massive 5-wave impulse structure. Wave 1 was the hesitant post-recession rally from 1982 to 1987. Wave 2 was the sharp, terrifying zigzag correction known as the Black Monday crash of 1987, which retraced a significant Fibonacci percentage of Wave 1 and created immense doubt. Wave 3 was the long, powerful, and confident heart of the trend, the great economic boom that ran from the 1987 low to the late 1990s. Wave 4 was a complex and frustrating sideways flat correction in 1994. And finally, Wave 5 was the final, euphoric, and ultimately unsustainable push into the 2000 high, driven by the dot-com bubble and marked by classic technical divergences. The entire 18-year drama followed Elliott's script with remarkable fidelity. The legacy of Ralph Nelson Elliott is one of the most ambitious and profound in the history of market analysis. His wave principle was not just a collection of patterns. It was a grand, unifying theory, an attempt to prove that the seemingly chaotic movements of the stock market were, in fact, an orderly and predictable manifestation of the natural laws of human social psychology. It is a magnificent synthesis of pattern, ratio, and psychology, offering a unique and powerful lens through which to view the ebb and flow of the markets. While its real-time application is a difficult and probabilistic art, its core insights into the fractal nature of market structure and the rhythmic pulse of mass psychology remain as relevant today as they were when he first discovered them. The Elliott Wave Principle gives us a grand, strategic map of the market's entire psychological journey. But to see the footprints of the smart money that often acts as the driving force behind these waves, to understand the mechanics of accumulation and distribution that take place within these broad global patterns, we must turn to the work of another master. For those who wish to truly master the lessons discussed here, it is essential to study them from the source. Please take note of a unique new edition of Richard Wyckoff's masterpiece, How I Trade and Invest in Stocks and Bonds, by Max Davidson. It has been meticulously adapted for the modern trader, with complete explanations that make Wyckoff's timeless wisdom more accessible than ever. For anyone who wants to truly absorb the lessons we are discussing, this adapted edition is an indispensable part of your library. The link to this book is located in the description of this video. The world of financial markets is vast, and there is no single path to mastery. Today we have dissected the wave-based structural approach of Ralph Nelson Elliott. But do not forget the other great schools of thought: the art of speculation and tape reading from Jesse Livermore, the analysis of market structure and the actions of smart money from Richard Wyckoff, and the deep understanding of time cycles from William Delbert Gann. Each of them offers a unique and powerful perspective on the market. All links to the channels for their in-depth study can be found in the description of this video.